Good morning. I am Dr.V.Deepha from the Department of Business Administration, Dr.S.N.S. College of Arts and Science. Today we are going to discuss about the financial management overview. Under financial management, it refers to planning, organizing, directing and controlling of financial activities such as procurement and utilization of funds in the organization. It ensures that every rupee is obtained at the lowest cost and used in the most efficient way. Under these key aspects, managing money, ensuring profitability, making investment. Second, nature. Under the nature first point, financial management is a managerial function. It is a part of the managerial activities, must plan, organize, direct and control the financial resources, setting financial goals, making financial decisions, implementing strategies, monitoring financial performance. Second point under the nature, financial management in decision oriented. So it is about the decision making. Under you have the three categories under decision making: investment decision, financing decision, dividend decision. Third, under nature, financial management is a continuous and ongoing process. It is not a one-time activity, it is a continuous process. So it helps to generate the funds, and the financial management to be a continuous activities, regular cash flow monitor, budget revision, investment tracking, risk, financial forecasting. Financial management is a goal oriented. The ultimate goal of financial management is a wealth maximization. That means increasing the value of the firm for its shareholders. To achieve this, financial management aims to maximize return, minimize risk, ensure financial stability, maintain liquidity, optimize capital structure. Under nature, the last point, financial management is a future oriented. It is also involved in forecasting revenue, predictive cost, estimate return, plan long-term investment, prepare the future risk. Next heading, scope of financial management. First one, investment decision, that comes under the capital budgeting. To select the investment decision, the company should invest in the money to achieve the maximum returns. Under financing decision, capital structure management, it helps the company to raise finance for investment through equity capital, debt capital or cost of debt, risk, financial flexibility, control, conservation. Third, dividend decision, it determines how much profit should be distributed to shareholders, how much should be retained by the future growth. Next, scope fourth one, working capital management, it comes under short-term financial management. It will be deals with the day-to-day financial operations like cash management, inventory management, accounts receivable and payable, short-term financing. Risk management, under risk management, it must be identify, measure and manage under interest rate risk, market risk, credit risk, foreign exchange risk, operating risk. Next, we are going to see the finance function. Under finance function, first one, decision making. Under that, investment decision, that comes under the capital budgeting. Financing decision, capital structure. Dividend decision, that how much profit should be shared with the shareholders. Fourth one, working capital decision. Then routine financing functions. First one, recording, keeping, cash management, credit management, budgeting, financial reports, safeguarding financial asset. Next, goals of financial management. The primary goal, it comes under the wealth maximization. Main goal, to improve or increase the value of the company through shares. Profit maximization comes under the traditional goal, to maximize the profit on the short term. Ensuring liquidity and maintaining adequate cash flow. It maintains liquidity to meet the daily obligations, that is paying suppliers, paying salaries, covering operation expenses, managing working capital. Minimum risk. Under minimum risk, every finance decision carries risk. It may be market or credit, interest rate, foreign exchange operation, whatever it may be. Next, we are going to see the role of finance manager. First one, strategic goals. Under this, designing financial strategy, managing capital structure, making investment decision, ensuring the long-term financial sustainability. Second, operational role. Under the operation role, cash flow management, working capital supervision, risk assessment, and cost control, ensuring compliance with financial regulation. Role of financial manager and the analytical roles: interpreting financial statement, forecasting and planning, evaluating financial performance. Next, we see agency problems. Under the first one occurs when management, that is an agent, and interest to shareholders principles. Different goals, lack of transparency, managerial perks, risk preference mismatch. Agency cost under monetary cost, it expenses made by the shareholders to observe, control, and regulate the managers. Bonding cost, it made expenses made by the managers to ensure or assure the shareholders that will be act responsibly and align with the interest with the owners. Residual loss, the last one under the agency cost, the cost of remaining conflicts that can be eliminated even after spending on monetary and bonding. Under the residual loss, it exists managing something, still making decisions and benefit themselves. Monitoring and bonding cannot eliminate every inefficiency. Human behavior cannot be controlled. Example, managers choose safer project, managers overspending on precious project or reputation. Thank you.